Hey, good evening, class. We're going to go through the second part of our lecture for this week. We are still on week number 3 of financial forecasting, and then we're going to go through the exercise itself. So bear with me. What we're going to do is that I have the slide deck that you have access to. So we're going to go through it, and then I'm going to use an Excel file. Now, it's easier to explain, and then so you can play with it if you have an Excel file. So I created the Excel file based on the problem that we have, right? And I did one that's an alternative calculation just to show you later on how it also can be done. So we might be moving the screen. I'm going to drag in the Excel file, then I'm going to drag it out, then we go back to the PowerPoint. So bear with me. So right now we are actually starting off with a sales forecast because in order for us to do a financial forecast, the first thing that we need to do is actually the income statement. Second will be the cash, then the balance sheet. In order for us to do the sales forecast, then we would need or income statement forecast. We need to actually have the quantity that needs to be sold. So let's go through our problem. So we have Goldman Corporation. So it's selling wheels and casters, and then it's actually 1,000 wheels and then 2,000 casters for 6 months. So basically, it will be a January 1 to June 30, 2022. So basically, that's the premise, right? 6 months only. Wheels are being sold, unit price of $30. Casters are being sold at 35 per unit. So 1,000 multiplied by 30 is 30,000 as revenue. 2,000 units multiplied by 35 is 70,000 for casters. 30,000 plus 70,000, we are looking at a forecast of 100,000 in dollar sales. Let me just make a change here. 100,000 in dollar sales, and then about 3,000 on quantities that need to be produced, both on wheel and then casters, right? Well, let me just delete that. Let's go to the next slide. Now, in determining the production schedule and then the gross profit, so basically sales minus cost of sales equals to gross profit. So we need to understand what's the beginning inventory, the projection, the one before, right? The PowerPoint before or the page before, and the desired ending inventory. So we did explain on the first part of week number 3, the video, why do we need to do an ending inventory forecast? So if you jump into this video, make sure to go to the first part of the video because we will explain the overview, why it's needed. Okay. Now, let me just make sure that we go through it properly. Oops, sorry. And then to determine the production requirement, we have actually a formula. If this is the 1,000 units or the 1,000 and then 1,000 of wheel and then 2,000 of casters or 3,000 units, that's your projected sales, right, for 2022, 6 months only. You need to add the ending inventory. So you would have a balance or you would have buffer stock before you start the next year or period. And then you need to deduct how much is your beginning inventory or a carryover from the prior year. So basically, because we're saying it's actually June 2022 as our ending, so we're thinking of December 31, 2021 as our beginning. So think about it this way. If we have our beginning and then we have our projected, or we have a desired inventory, if I actually have projected sales plus the ending inventory, that's the one that I would need to actually produce, or the goods of the goods that needs to be produced, right? That you would want to produce. But because you have beginning inventory, let me deduct that. This is the only thing or the quantity or the production requirement that I need to produce this period of time. So logically, it does make sense, right? And then now we have here a stock of beginning inventory. So we have 85. Let me just make sure we change the color so we can see it. 85 units of wheels, and then 180 units of casters. This cost here, because this is actually stock or inventory, so this will be unit cost. So this is the cost. So this is the cost, right? Unit cost. This is the cost of the product, which is $16 to produce, and then $20. Now, if it's a merchandising business, it's actually the cost to acquire. This example right now is a manufacturing business. We would see later on because you have your materials, labor, and then overhead. So it's a manufacturing business. Then this is the cost to produce, right? The total cost. So what's the breakdown of that 16? 16 is the total unit cost to produce, which includes materials, which includes labor, which includes overhead. So you should actually have learned that on your AC 202, right? Principles of Accounting 2 on the manufacturing side of things. But if not, then the unit cost at $16 for wheels and $20 for casters consists of three items: materials or direct materials, direct labor or labor, and then overhead. Okay. So here, basically, there's a production requirement for 6 months. If this will be our quantity that we need as a forecasted units, and then this is your desired ending inventory, if I add both, that will be your that will be the goods that you are thinking to produce. But because you have beginning inventory carryover, let me deduct that. This will be the units to be produced, right? This is what you're thinking right now to produce, this two, right? Or this section here. But you know you have your beginning inventory, that's why you deduct it. So this is the items to be produced only, units to be produced. Now the unit cost per product, we're talking about unit cost would flow as a cost of goods sold, right? In your income statement. The prior table, the very first one, we saw sales forecast. So that will be your sale. Then this one will be your cost of sale that you need to consider both on what you produced and also the unit cost of your beginning inventory that will be sold in the current period. Um, we talked about the breakdown. The breakdown normally includes materials, labor, and overhead. And then these are the unitized. So that's why we say for each unit. $10 of materials, $12 for casters, then you have 5 and 6, and then 3 and 4. So materials, labor, and overhead, it costs $18 to produce wheels, and then $22 to produce casters. Now, when you think about it, so where is this coming from? This 1015 and 2020. That comes from, sorry, that comes from our item on, I'm going up here, which is actually the units to be produced. The only thing that we're doing right now is multiplying it with the unit cost to get the dollar amount, not just the quantity, but now the dollar amount. So we know in the prior slide that it costs you $18 to produce wheels and $22 to produce casters. If I multiply 1015 of wheels multiplied by $18, 2020 multiplied by 22, so that will be 18,000 and 44,000. Add both, it will be 62,710. Now we would need to do the cost of goods sold. So cost of goods sold, there will be an assumption of the flow, right? So basically, think about it this way. If you have inventory from prior year, December 31, 2021, and then right now is June or it's 2022 for our example right now. of course you're gonna be selling. Your assumption will be to sell the item from last year while you're producing what you need for this year, correct? So that's actually the assumption for our illustration. There is a first in, first out. What came in from last year, first in, will be the one that needs to be sold first out. Okay, so that's actually the assumption. Some companies would say that I don't carry over ending inventory, which is very, I would say no company really does that because you need to have an ending balance always, right? You need to have an assumption of an ending balance. Unless you are a just in time uh, type of business. So the challenge with just in time, you might hear this one or you might have read it in car manufacturing, like say Toyota. Toyota would actually do a just-in-time inventory system using Kaizen method, the most efficient way of managing inventory. So why do people want to have a Kaizen method, or why do they want to have a just-in-time inventory? Because inventory, if it's actually staying somewhere stored, it would incur warehousing. It incurs also admin costs to maintain. If it's staying there for more than 30 days, it needs to be inventoried. It needs to be inspected. If it's perishable, it needs to have some form of air conditioning, refrigeration. If it's non-perishable, it needs to have some pest control. It not need some AC. There's a lot of cost involved, right? When you think about it. So if you only get the inventory that you need to produce something, then that's just in time. As long as you're depleting the inventory, instantaneously delivery happens. So Toyota does that, or a lot of Japanese manufacturing companies will do that as a methodology of inventory management. Now, the challenge we've seen is what's in actually in 2020 when COVID happened. When COVID happened, the global supply chain became more erratic, right? Because there's no distribution lines that are available. Aviation was actually impacted. There were no pilots flying because they're either sick, there's a shortage of staff, same as by train or by freight, like sea freight, by air freight, or by locomotive or train or rail system. So the global supply chain got impacted. That's why the team now is doing also a hybrid type of inventory management, wherein it's not only just in time, but they have a buffer stock, thinking that there always be or there will be a risk of supply chain issues. So, but for now, in our problem, we're looking at the first in, first out as a cost methodology. Now, I'll shift to the Excel file. Let me drag it first. Okay, here we go. So let me delete this one. This is the Excel file. We're doing the first one, week number 3, financial forecasting. Then we'll go to the alternative, right? I just typed it in so it's easy. And then something that will be easy for you is to actually take a look at the linkages in the Excel file, which I did here. Now, things that are, we'll try to do some shortcuts in Excel. If I use Control tilde, tilde will be tilde, I think tilde or tilde. It's basically the keyboard or the keyboard below the escape. So if I press, I'll go here, Control and then tilde. So now you would see that there are formulas embedded. So that's one way for me when I review your work, right, or your assignment. I will press Control and then tilde, which is actually the squiggly line, the key below escape on your keyboard, and then it would show you all the formula. So normally I would browse, right? Why? As a data analyst, as a accountant, as a finance person, what you're trying to avoid is that people might hard code the final amounts, which does not make sense because if you hard code it, if you change the input numbers, and this is hard coded, like say quantity and sales is 1,000 times 30, and then that's 30,000. But if this one, cell B8 is hard coded of 30,000, then it would not actually be dynamic enough. It changes, right? So I always do that. So how do we go back? Press again Control, then Kill, and then it goes back to the original one. So original format. So that's one thing. Let's go back. We first do a, a forecasted sales, right? So this worksheet is designed to go down, from left, down, and then to right. So we would actually do it that way. Um, we always say that accounting or documentation for accountants is important. Presenting data as accountants as a finance person is also important because your worksheets are your communication tool when you talk to senior management. So we want to make sure we try to properly format the Excel sheets. So we have the forecasted sales, which is basically quantity multiplied by sales price. So we have the 30,000, 70,000, and 100. So that's easy. And then now we have the, I'm using other terms, so we would know what it is, right? In stock, stock on hand is the same thing, or the beginning balance. And then now that would be your quantity here multiplied by the unit cost. Okay. And then when you add for wheels and then casters, so casters is actually on the second column, the total is 4,960, or basically 5,000, right? Now there's a production requirement. So we're saying that, let me just go through here. I'm going to use the cursor now. The production requirement, I just do a link, right? I'll press F2. So basically, the information on the sales, I'll place it there as projected sales. I'll press F2 again. Then I will add the desired ending inventory. Now, the desired ending inventory is basically a percentage of your projected sales. In this case, we're looking at 10% of your projected sales. That's why we have this formula. Projected sales multiplied by 10%. Similarly, it's the same on casters. Then I would need to have a negative item. So I linked it up on our beginning balance, but this time around, I need to make sure it has a negative sign after the equals. So it's easier for me to actually press Control and then sum, the sum function. So an Excel shortcut will be, or your normal function is equals sum, right? Something like that. So another way of doing it is actually pressing Alt and then equals. If I press Alt and equals, it would immediately calculate anything without a space. In this case, because I included a space here, which is actually line 19, so I need to move it one time. But if you just do a quick one, that's basically your quick formula. Let's do it this way. Okay, I'm doing Excel shortcuts also that you may know or may not know. If I need to add these three numbers, I'll do Alt equals Enter. Then now it's 6. I need to have a double rule right on the bottom. I will do Alt H B B. So BB meaning that it's double rule. So when I see that, then you have a double line. Under number 3, I would need to have one line below, right? So I always remember it's just like HBO and HBB. Alt HBO, like the TV, right? And then that's one line. HBO, one line. HBB, I will just try to remember HBB is like double. So that's my mnemonic, right? And then that's the one. And then somebody would say, hey, you know what? This is actually a dollar amount, right? Just in case it's not a quantity, but a dollar amount. Then what I need to do is that I would need to press Control Shift and then the dollar sign. And then I'm going to go down here, Control Shift, then the dollar sign. And then somebody would say, okay, Well, that's not actually efficient, so I'll do one more. Control Shift dollar sign. And then what I'll try to do is that I'll go down here and press F4. When I press F4, it remembers the last Excel function that I did as a formula, so I don't have to repeat it again, which is Control Shift dollar sign. Now you would say, sir, your dollar sign is not aligned, right? Because it has the dot 00. So your other numbers does not have. So um I will do Control Shift and then number 9. Sorry. Sorry. It's not Control Shift number 9, it's Alt H9. Alt, let me just do it this way. Alt H9, sorry. Alt H9 would actually be way wherein you take out the number of decimal places. If you have two decimal places, you would need to do it twice also. Alt H9 and then Alt H9, like that. Now you would tell me, sir, it's all crooked now, right? So remember how we did the USD formula, which is actually this one, Control Shift dollar sign. And then the Alt H9 is actually um, reducing of the decimal places, which I need to change. Kindly hold, guys, okay? Alt plus 9. Alt plus 9. Just want to make sure that we actually correct that. There you go. Alt H9. So it does not look the same. What I normally do is that I will do another formula we're in. It's going to be, so when I press Alt, right, what does happen? I always use Alt and Control. When I press Alt, okay, your ribbon would actually now change. You would have your, let me just make sure I can, oop, it changes. It would now change. I press Alt. Your ribbon will be activated. And then H is actually home. So I'll press H. And then the entire section on home is now activated. And then I see the dollar sign there showing AN, right? AN. So I will do a Alt HAN might be a way wherein the dollar sign would not be too close to the number 1. So Alt HAN, sorry, Alt HAN. And then now what happened is that the dollar sign is actually engaged, or the current sign is engaged, and I press enter. And then now I don't need the two decimal places. I will do Alt H9, Alt H9, 2. And then here I will do number 4, or sorry, F4. So F4 means that it would repeat your last function that you have executed. So I don't need to do it again. You would tell me, sir, your numbers are still off, or the alignment wise. So I will do it by creating making it as a number, right? So I will do Control Shift, um, Control Shift the exclamation point, just actually here, to make it two decimal places. But at the same time, I would want to actually do a Alt H9 to reduce it. And then I will go down, arrow key down, F4. Then it's actually gonna be aligned. Should be aligned, but it's not. There you go. Now it aligns it, and then that's actually some of the Excel formula that you do. Now you would say, okay, that's a lot of keystrokes, but maybe the mouse might be better. The mouse can be good to use, but when you're doing a big spreadsheet and then working on using the keyboard might be a better way. And then even going from one page to another, or tab, control page down, control page up, right? And then if I want to go back, our cursor is actually here. If I want to go back to A1, control home. So now the cursor is here, I'm control home. If I want to go to the very last cell on this tab, control end, then that's actually where the last set of data is. If I want to go up again, control home, then that will be it. Let me do one thing. If I pull out a data equals, and then I go back and pull out 1000 here, just for some reason I linked it. How do I know it's here? If I want to go back to the source of the 1000, what I do is that I would actually press control and then the arrow or the key that is actually to the right of the letter P, which is the bracket sign. So control then bracket sign, that's the source. Press F5, press enter, it goes back. Let's do it one more time, right? Control, bracket sign, control and then bracket sign, that's the letter, the key after the P to the right side. And then of your keyboard, then it goes there. Then press F5. F5 is go to, your source is activated. I'll just press enter because right now your OK is defaulted. Okay. So just don't check in Excel because later on it would actually help you out as you go through. Sorry, I needed to show that to you, and then I updated some of the shortcuts that we have. Let me just delete this one. So when I send it to you guys, it's actually clean, right? So I have a lag in Excel, if you can see it. Reason why is that I'm using this program. And then if I'm recording it, I always feel that there's a lag, right? But I need to use this tool so we can guide each one where we're at. Now going back where we're at, I have a check on the sales forecast. I have a check now, or I know what is the balance. Basically, beginning balance, you just multiply it, then you get the total. Then you have about 5,000. I do understand now, or we should know by now, why we need the production requirement. It's the projected sales, add the desired ending inventory, which is 10% of the projected sales, and then deduct the ending inventory, which are actually coming here as quantity, right? So these are units to be produced, still quantity. I'll delete that. And then I'll go back here. I'll go down, right, as we go through. And then now, remember that you have a cost to produce each item. So it's given $10, 5, and then 3 for materials, labor, and overhead respectively. Then you have both wheels and casters, 18 and 22. We remember that from the PowerPoint slide. The units to be produced is basically a link to what we computed a while ago. I'm pressing F2, escape, go here, press F2, you can see the link, press escape. I pulled out again by linking equals to the units produced, press escape, and then linked again. And I multiply it, right? 1015 quantity multiplied by 18, escape. And then 2020 times 20 times 2, escape. And then I added that one. So I'm going to delete this and then I'm going to do control or alt equals enter. So basically my formula is alt plus the equals sign. So this formula is to actually sum up, right? Because sometimes what you do is that you do the equal sum, open here, go here, takes a while. So I will just do that one and enter. Okay, so it's easier. Sometimes one more trick might not be applicable here, but let's just give it a try. I'll highlight. How did I highlight? I press shift. I move the arrow key 1, 2, 3. Just in case that the column right now, you just need to add down, right? I'll do alt equals, and then there you go. And then I will say underline alt HBB, and then you BB is double dual, so sorry, HBO HBO, and then I will do here again HBB. Then now you have a properly formatted in case that you need to add it up. So right now it's not, right? Because it's the table by itself. But wanted to show you applications on how to do it. Okay, now I need to get the ending inventory. So what we've been doing right now is basically income statement, income statement. Everything up is income statement. Just want to make sure that we see that, right? But on the balance sheet, you would need also the ending inventory, the dollar amount of the ending inventory. So how do we do that? Because we have the data before, we're just basically linking. Let me make sure that we can show that. I'll press F2. How did we get the inventory balance, the beginning balance inventory, dollar amount? I linked it up on a prior schedule and then even the total. What about the production cost? Well, the production cost for the current period, I have a schedule above. I just multiply it. I just bring it down. If I add both beginning inventory plus production cost, it will be the cost goods available for sale as a dollar amount. And then if I deduct how much needs to be sold or cost of goods sold, then that will be your ending inventory. Now, how did we get the cost of goods sold? Because we already know how much we need to be selling. And then that was actually given in the problem that we have. So we are looking at what's the projected sales? It's 3,000, 1,000, and then 2,000, right? If I add here, 85 plus 15 is equals to 1,000 of wheels, 180 plus 182 or 1820 of casters. That's basically it, right? But now on the FIFO cost of goods sold, we know that the source of the 85 and 180, so this two here, quantity, is basically what? Your beginning balance. And then the the 915 and the 1820 are the ones that you need to actually sell based on what you have produced. How much was produced? These are the quantities produced, and out of that, 915 and 1820 were sold in 2022 June or year to date 2022. So you would ask me, but sir, why is it important to bifurcate, or why is it important to split, or why is it important to identify? Reason is that the unit cost of the beginning balance and the unit cost of the current item produced are all different. Let's trace the 16 and 20. These are the unit costs. Because it's a different period of time, the unit cost is different. And then the 18 and 22 is actually based on the unit cost of the items that you produced in 2022. This one, I should have used a different color. Let's do this just for illustration purposes. I'm going to use a different color, not that. The 16 and 20 that came from this layer, I'll just highlight it. It's actually in 2021, right? This is 2021. And then this one is in 2022. So that's why you do have two different costs, because every year you have fluctuation in cost, efficiency gain, maybe a change in vendor. That's why you always need to trace it. Um, in finance, or if you're doing finance, you might not need to trace it because the accounting department traces it for you. But if you're the one doing the forecasting and you're in accounting, you would want to actually understand how it actually flows, right? So that's the reason why when I'm thinking about this week, I needed to make sure that you would understand it by having an actual Excel file that I will send it out rather than just the PowerPoint. Because the PowerPoint, we would not go to the actual details because it's a picture of the worksheet. So let me clean it up so it's easier, but you would know where it is coming from. And then I will give you the file so you can go through it also. Let me delete. Now, if I have this 85 and 16, if I multiply that, this will be the cost of the beginning inventory, which is actually the same here, right? And then the 18 and 22 coming from here, but the quantity is different of what has been sold. Actually, you can trace it here. Let's see. 19 and then that's 50, sorry, 56, 510. So maybe not. I'm just like looking if you can actually trace it because normally you can work it back. So 18 and 2022, 18 and 22 is here. 915 and 1820 is basically when you add both, that'll be 2000. If I add 85 and 915, it's the 1000 of what is forecast to be sold. And then also on the cost of goods sold, if you multiply it, it's 56,000. The cost of the product that you produced in 2022 that you also sold. The cost of the product in 2021 that was carried over in 2022 and you sold in 2022 is about 5,000. If you add both, that's 61,470. That will be your cost of goods sold. And then this amount, I would say you can trace by going down here. So let me just make sure we delete that one. The 61,470, you can trace it also on the cost of goods sold. That became your ending inventory. Okay. I know there's a lot of formula, and then that's why it's important to do it on the worksheet side, right? Now, when you think about it, we are almost done with our income statement. Let's go to the right side of this Excel file. If I go to the right side, I have a notation here, so you can actually see it. And then let me go for a quick minute to the Excel, to the PowerPoint that we're looking at. Kindly hold, guys, okay? So on the PowerPoint, let me delete that one for now. It's basically the same, right? Like we have the same 61,000, but I presented it on a different manner. You can still use the PowerPoint slide. But at least now you can actually figure out the formula by going back. Here is the pro forma income statement in 2022. So you would see that some of the numbers are actually given, right? So this is the given. So I'll go back to what we have in our Excel sheet. So I'm going to move it out. Then the same thing. Maybe I'll do this, guys. Okay, so you can actually see it. Let's see where that thing is going to show up. There you go. I have a screen capture. Want to make sure that you can see it now, right? And I'll make it a bit big so it's easy for us to see. Maybe not that big, but I'm going to show you the link. Okay, guys. So the sales and then the cost of sales are basically linked. How do we have that? I have it here, sales, which is basically coming from here. And then the cost of goods sold is basically coming from here, which is all linked to the supporting documents that we have. Sales minus cost of goods sold, it's actually gross profit. It's a formula driven calculation. We move this aside. So I put here formula. So you're not confused on where it's coming from. 12,000 is a given. If I press F2, it's hard-coded. Gross profit minus operating expenses, which includes general and admin, is equals to operating profit or EBIT, earnings before interest and taxes. It's formula. The interest expense is a given in the problem. It's 1,500. And then now earnings before taxes, which is actually EBIT or operating profit, minus interest expense is actually earnings before taxes, EBT. And in taxes, it's 20% of EBT. So that's why when I press F2, it's actually Y13, cell Y13, which is actually your EBT multiplied by 20%. And then I will do A, earnings after tax of EBT minus taxes. Then the dividends or the dividends given, this will be your increase in common stock. So it's basically the thing, right? So basically, we're done with your forecasted income statement because you needed to create a lot of the information with regard to the income statement itself. Now, I'll cut this, I'll cut the video. So because the next video, we will now continue by going to the balance sheet. So I want to make sure that you have enough time to um, check on it and then maybe open the Excel file and then play with it before we go now to the next one, which is actually the cash forecast. So I'm going to end this video for now, and then we will see each other on the other video. Okay. Thank you, everyone.